Hello and welcome to episode 62 of Crypto. My God, markets are like, they're okay. I'm not super bullish though on their direction right now. I think that in the short term, we've got a lot more pain coming. This tariff shit, it's a conundrum. However, eventually I do think we'll see the money printers activate globally and cash should flow back in. So long-term bullish, short-term, I got no freaking clue. But what can you do in the meantime? Well, DeFi is always here to help you earn and grow that wealth that you have right now. So if you are going to ride this through, let's at least look at what you can do with that digital money. Bam, let's get into it. All right, familia. So I just picked a couple of the larger platforms that offer yields in a variety of ways. And what is exciting is that the last cycle blew up because of fake yield. We really started to get into the yield game around the FTX, the BlockFi, Celsius, Voyager lending protocols, and a lot of that was tied up with Three Arrows Capital, a hedge fund, and FTX. FTX really tried to blow up Three Arrows in order to take out the lending competition, but of course they got caught up with their own chicanery and they went down. And good. Let's wipe it off the face of the earth. The thing with yield is you have to know where it comes from. If you don't know where the yield comes from, you are the yield. So let's check out some opportunities that are out there. Now, the space is growing, and I think it's really cool. One of the things I do like about some of the RWA yield opportunities is that yield is one of the few things that we can move between that veil of meat space and cyberspace. Obviously, cash has gone digital, so if we can take forward-facing revenue, cash itself, we can digitize that through stablecoins, etc. So we've got some really cool things like Centrifuge, for example, which is a protocol on Ethereum. And this is for larger players, but it is something that I do find to be quite interesting when we look at how money markets are going to operate in the future. So they have larger investment tranches here. So you can see that the minimum investment's around 500K. So we're talking like institutional kind of stuff, but we're looking at a basket of treasury bills. So you have a bond option right here for 5% APY. We have DeFi yields, which is stepping up the risk profile, but it's offering 15% APY. This is an actively managed, diversified portfolio of market neutral DeFi yield farming strategies. So you're probably going to see a lot of carry trade kind of things where you long an asset and short the other side of it in order to get the funding fees from perpetual markets open interest. And over here, we have a third bond option, which is a collateralized loan obligation. So these are people taking out loans, willing to pay a premium, and you earn 6.5%. These are all pretty cool. Now, we can see that the future, it's a little faded here because it hasn't come to fruition, but these are things that we do expect to see. Real estate, consumer loans, music royalties. I mean, you are looking at the transition of RWAs into the digital sphere. I find this to be pretty dang cool, even if this isn't something for everyone on my feed. Obviously, 500K, quite expensive. But this is like a goal of Centrifuge. Now, what Maple Finance offers is a lower risk profile lending system. And the way they do that is basically lending to real players, to institutions. So you have Blue Chip Secured, which is the Blue Chip Secured lending pool, lends USDC to leading institutions over collateralized by BTC and ETH. So you can get 7% with BTC or Ethereum by lending this out to institutions that are going to trade on it. High yield secured is a similar thing. You're going to lend these assets to traders, and this involves a little bit more liquid altcoins. That's why you're seeing the 10% versus the 7%. 7% is de-risked. It's Bitcoin and Ethereum. I mean, man, ETH might be adding the risk on now, but BTC is pretty risk off. And that's funny I say that given its volatility profile, but high yield secured is the same kind of thing, offering liquid altcoins. So you can see how we sort of adjust. And 5% on Bitcoin, which is pretty interesting. Now, how do they do this? Maple uses what's called Core, which is sort of a mix between the Bitcoin and the Ethereum worlds. It's using Bitcoin proof of work on the EVM, and this allows them to act as sort of a bridge layer. Now, you are tossing your coins over to somebody else. There's always risk with that. But I think Maple is a really interesting way to generate some yield on your assets if you know that you're just going to sit through this next shitstorm and try to ride it out. At least your underlying, as it goes through the volatility on price, will be earning yield day in, day out. And that's pretty attractive. Now, the yield game is evolving like crazy. My buddy is the CEO of this project, Metastreet, and I think they have a really cool environment that they've gotten into. What they're doing at present is what they are calling Node 5, which is that they are allowing you to get some ownership stake in the really in the value side of this, around GPU node clusters that are being rented to AI companies. So AI is extremely data hungry. People are setting up these data centers not to be used by themselves, but to say, hey, let's rent out these flop cycles. Let's rent out these computing cycles to AI applications. And there's quite a heavy demand for this, right? The GPU race is quite aggressive at this point in time. Getting those N100s is quite tough. So they have this cool element where they're leaning on DeepIn, right? Other people can facilitate these setups. They can set up the hardware and lend their compute to these DeepIn networks. What you can do here is actually contribute your USDC, your stables, your assets yourself, so that they can go out, purchase more GPUs, and scale up these DeepIn networks. Here we have Aether, XAI, and you can see these are a little bit more akin to a traditional financial product. They have maturity dates, and you are getting basically a consistent pay rate. Now, they've done this previously with NFTs. I thought this was a really cool play, but the NFT hype bubble kind of came and went. But you can see that you can put in NFTs for lending, and there are people that actually actively buy and sell and trade NFTs. So Pudgy Penguins being one of the main ones. They do have CryptoPunks in here somewhere. But for the most part, we are seeing these DeepIn networks being their current focus. Now, if we go to earn, we can get out of the crystals, which is really their point system for a future token. But what we can see is that you can now lend to a lot of other things like RWAs, right? Watch-backed NFTs if you want to go long watches. But let's go in here and mint, and we can see that if we're lending tokenized DeepIn, so this is investing or providing liquidity to DeepIn networks so that they can scale their hardware, you're going to get a 13.6 APR. Now that's pretty interesting because it is going long on DeepIn. DeepIn seeks to fix the bootstrapping mechanisms of starting a new hardware network, and this is a way that you can provide capital to that bootstrapping even further to say, hey, if you want to participate and earn those rewards that the DeepIn network is built for, here's a little cash up front to go scale up. So that's where that yield is coming from in that APR. Now, of course, let's say you're holding Bitcoin because it's probably the smartest thing to do these days. The Stacks ecosystem is quite interesting here. And this is a Bitcoin L2. So the way they operate is that Bitcoin miners can also run Stacks in parallel. Now, when you commit a Bitcoin to the Stacks network, that is actually reflected in the Bitcoin network itself. So this does cause Bitcoin from the Bitcoin network to lock itself up, and that's how Stacks really generates its yield. Now, everything that happens on Stacks is paid back in Bitcoin itself. It's a pretty cool ecosystem. It's been around since the early days. They pioneered a lot of decentralization. They were actually the first and maybe the only instance that I know of that has a legal memo saying, we believe we are sufficiently decentralized. They ran a Reg A sale, which is a very compliant offering from the SEC. It actually requires SEC approval. And the cool thing is it lets like everybody in. You don't need to be an accredited investor. It's basically like mega crowdfunding that converted into a coin. So they ran that token sale, I want to say back in 2017. I might be wrong there, but around then. And then over the course of a couple of years, they announced that they were sufficiently decentralized. And suddenly, not only did they do the initial offering to as broad a set of people as possible, but now it is open and decentralized and run by the participants in the ecosystem. So Stacks is an L1. It has a bunch of apps on it which offer their own things, but Stacks, you can actually stake your Bitcoin to earn more Bitcoin, which is pretty cool. Now let's hop into Solana world because everybody's on Solana. I know it's like the hot chain. Its utility is great. It's just fast, quick, easy. However, there's a lot of fees involved in Solana and it's a little bit weaker on the yield. So for holding Sol, I mean, again, supply APR is like 2.28%. And one nice thing about Solend is you can take a lot of the assets from other chains, put them on Solana, and I guess they have base here, right? CBBTC, which is Coinbase BTC. Of course, we can earn 3% or 2.5% supplying stable coins, 3% on USDC, but why, I don't know. You could do it here. Now, the thing is, with Solana, you're only earning 2.28%, so why not just go over to Jito Foundation, which is collecting a lot of the MEV rewards. And one important thing to know about Solana, about half of the fees that you spend are being captured by MEV. So even though it's cheap, half of all of our cash is not actually going to the transactions. It's going to the reordering. It's going to the infrastructure of how Solana maintains its transactions and forms its blocks. Now, One interesting thing is that Jito captures a lot of that MEV. So if you prefer to stake your Solana rather than going to Solend and lending it out for other people to trade and borrow against, you may as well just stake it because you're going to earn 7.93%, which is a combination APY from Solana staking rewards, which is somewhere around 3, plus another boost from all of the MEV. MEV is ordering transactions in a certain way that benefit the host that does that reorg. And it's part of every network. There's a lot of ways to make sure that your digital money is actively earning. Again, digital capital wants to be in motion. It is meant to move like information over the web. It is not meant to stay stagnant and sit in your accounts. We want to be earning yield on basically everything we do. And of course, you could stack some of these things. So there's a lot of interesting things to unpack there. If there's any one of these protocols in specific that you really want me to focus on, I'd be happy to. But if you're just sitting around looking at the numbers go up and down and you know you want to hold for a long time, you should dive into yield opportunities. You should have a clear understanding of where that yield comes from. It needs to be obvious. That is your risk profile. And there's opportunities inside of each and every ecosystem, whether it be Ethereum, Solana, Cosmos. I mean, XRP is probably going to have something coming up soon. So anyway, last but not least, we have a mega article coming out today about Operation Chokepoint 2. This is from Nick Carter, who basically came up with the whole concept of OCP2. And suffice it to say, the Trump admin is really going to be gunning for some of the figures involved here. I could argue, it's my strong opinion, that this is actually the reason for Trump's victory. I think if this had not occurred, if you didn't have Elizabeth Warren gunning so aggressively for the crypto community, you would not have all of the votes that actually accumulated to, I've heard this coming from the Trump admin, 10 million votes. That was a major impact, and I think this is what lost the Dems the election. So this is a really interesting article on what happened, how they actively killed Signature Bank as a means to debank cryptocurrency businesses, and also an assault on Silicon Valley, which again, Elizabeth Warren really hates Silicon Valley and technology. So you've got a lot of old people here that are very anti-tech, that can't see a future that they're not accustomed to. And the assumption here is that they took some criminal steps to get rid of these bankers that facilitated the cash flow. I can attest that if you were in crypto during that period, getting and maintaining a banking relationship was extremely tough. So this is a really great read. It's a little bit of a non sequitur. I'm just going to toss it in at the end. Of course, the link will be in my description. And as always, fam, good luck out there and stay safe.